Welcome everybody. We're just going to give people a chance to join us. Well, we have our martinis made.
Martinis, sun is shining. Martinis are going to be made.
What are we drinking today, Ashley?
We are having a classic vodka martini made with Tito's vodka.
Right.
Shout out to Tito's.
3 ounce martinis.
3 ounce.
4 this time.
We had to rid the band of 5 ounce martinis.
4.
Thank you.
Cheers.
Cheers.
All right. Welcome to Martinis with Scott, episode 7. Guest today is Kevin Westfall. If you have your drinks, have a sip with us. Brought to you as usual by Sinclair Range. Sinclair Range is an advisory firm in New York and Toronto and Calgary. We help companies transition, companies that are in financial trouble, companies that are experiencing high growth, and we help them with their capital transactions. I won't spend much time on it, but go check us out at sinclairrange.com. And my guest today for episode 7 is, as I said, Kevin Westfall, who is Vice President of Accord Financial.
Thanks for having me.
And has spent years helping the exact same companies that Sinclair Range
20 plus, since
helps.
the early 90s for sure.
Right?
Yeah.
So before I get into what Accord is, I just want to say that I came up with this idea of Martinis with Scott maybe 6 weeks ago,
Right.
8 weeks ago. And for whatever reason, you and I were talking right around the time that I came up with the idea. And you were an early adopter. I said, hey, Kevin, I'm thinking about this. What do you think? He's like, that'd be
we
cool.
can chat and have martinis. It's a great idea.
It's all a good idea.
Absolutely.
So Accord Financial, according to the notes that were given to me, we've been in business since 1978.
Right.
Headquartered, it says headquartered in Toronto, but you're headquartered in Montreal, are you
So
not?
the lending business is headquartered in Montreal with Mr. Moss and
Yeah.
Jason and the team, and our Accord Financial Limited, which is our credit guarantee business that started in '78. The head office with Mr. Hitzig and so on, to be based in Toronto.
Okay. And publicly traded.
TSX, ACD.
Symbol is ACD. Helps businesses secure financing when conventional banking may not be an option.
Right.
And so that includes companies that are going through rapid growth.
Absolutely. We're in a startup phase.
Yeah.
So early stage, too early for the bank.
Right. Companies that are financially troubled
Yes.
or restructuring.
Mm-hmm.
And buyouts.
Right.
And buyouts would be what? That would be management buyouts,
Generally
shareholder
speaking,
disputes.
Generally speaking, an MBO type situation for sure, where management's buying it out,
Right.
may not necessarily have the equity or the support. They'll leverage the existing assets.
Yeah. You have offices in Montreal, Toronto. We talked about you have an office in Vancouver.
Right.
You have an office in Greenville, South Carolina.
So that's the head of our asset-based lending division is in Greenville, South Carolina.
For the U.S. or
For the US.
For the U.S.
Right.
And Chicago and Santa Monica.
So Santa Monica is a company called Bondit that we partnered with 2 years ago. So that's film production finance and tax credit financing.
Oh, really?
And then CapEx Partners is based in Chicago, which is equipment financing.
So the film financing, the tax credit, do they have tax credits in California? I thought that was largely a Canadian
In the U.S.
scheme.
and in Canada, for sure. Yeah.
Really?
Mm-hmm.
Okay. We did a ton of tax credit financing for films back in, I don't know, feels like 7-10 years ago. For some
And
reason,
the banks were heavily involved at that stage too.
and they're out now?
There's a couple of banks left. I know Bank of Montreal is very active. National Bank is still very active.
Okay.
But it's like anything when they don't qualify for the bank type finance, they really kind of had nowhere else to turn.
Right.
So Bond became a great solution.
Share price, I don't know what today was, but when this was given to me this morning, $10.24.
Still hovering around there.
52-week high of 1045, 52-week low of 880, market cap 86 million, which is a lot. That's good.
Nice. Always nice to have equity.
Yeah, and what else do I have here? Net earnings rose by, you've just been knocking it out of the park, is the bottom line. So net earnings are up 72%. You've got, skip down to the important parts here, $340 odd million in AUM.
Right. And
Right.
it's grown significantly since 2016.
Up up maybe 54%.
Right. And some of that is through acquisition of bonded and CapEx and kind of just the partnerships that we've entered into there.
It's a good stable stock, as far as I recall.
Has been for a lot of years, yes.
Yeah, a lot of years. Pays out a dividend.
Mm-hmm.
What else can we tell you? You've got a new credit facility,
right,
for $292 million.
6 banks on the syndication,
which was a six. So, was that the first leverage at Accord, or
yes,
really?
yes. That's what the market said. Really?
Exactly.
Yes, that's the first leverage.
So that lowers your cost of capital.
Yeah.
Pretty dramatically, right?
Absolutely.
Gotcha. And as for you, you just joined Accord, January 2019.
So my second stint, I was with Accord for a couple of years in 2012 and 13.
Yeah.
Left and joined a firm called Bridging Finance. Left Bridging Finance and helped launch a firm called Pivot Financial.
We don't talk about that.
And we kind of, yeah, right. And we run kind of, it's just the roller coaster. It's up and down and up and down. And if you're in the alternative lending space and you're not the bank, you need funding. And you need stable funding, and you need kind of, regular streamlined funding.
Right.
So taking on large tranches of cash with kind of the panic to deploy, or kind of trying to seek capital as it's going out is always kind of a stressful life to lead. So the opportunity arose for me to rejoin Accord this year, and I gladly accepted.
What I've learned in the Canadian marketplace, maybe it's the same in the U.S., but the funds available to this space shift, right? So
For sure.
in your career, you've kind of followed
Yes.
some of that.
Yes.
Does that make sense?
Absolutely. Absolutely does, yeah.
Yeah.
I mean, obviously it's a very liquid market right now, so there's a lot of alternative funds available.
But who is there in Canada? There's Calidus, Bridging, Accord, Wagar.
Yeah. Those would probably be the keys. There's Next Edge Capital, which is kind of the liquid capital group.
True.
AccuTrack, which just got purchased by, used to be called Trade Finance Solutions. I think they're called Global Merchant Fund now.
Okay.
So the Global Merchant Fund would be another. But yeah, I think that would be kind of the core of those types of funds.
Says you're a board member of International Factoring Association.
Right. I mean, I kind of cut my
that?
teeth. I kind of cut my teeth in the factoring space, in the alternative lending space. So way back when I kind of worked in the bank and in personal finance, didn't really love that and got into factoring early on. And I've been in factoring and kind of evolved into asset-based lending sort of scenario. So it kind of goes back, factoring background of about 20 plus years. The International Factoring Association started off as an association in the U.S., really just as an alignment of factoring businesses trying to regulate each other. So without kind of, regulatory and government type of regulation, we kind of took it upon ourselves to regulate each other.
Yeah.
So it started an association, and then that association kind of just morphed into different things. So like an ACG, for example, or a TMA that would have different chapters, they have a Canadian chapter of the IFA that I'm a board member of.
I should have mentioned that we're filming today at the 20 Bay Street office of Sinclair Range, and if you can see up Bay Street as we typically do, and we haven't been shooting in the U.S. much yet, but it turns out the analytics on this are that 2/3 of our listeners are from the U.S.
Sure.
And so it's, I think the American companies, U.S. businesses have many of the same issues, and the Canadian accessing capital, and the Canadian lenders, I think the ones that we mentioned, almost all of them are cross-border.
Agreed. Yes.
Like I thought Wagar was strictly Canadian, but I learned last night they're now cross-border as well.
Into the U.S., yeah.
Yeah. So, okay.
I think there's only a few that have physical offices and corporations incorporated in the U.S. like we do, but
right.
There's others that'll lend into the United States.
Yeah. I want to go through your product line.
Absolutely.
And I want on each point for you to give a little explanation as to what it is.
Yep.
And maybe like the first two, for example, are asset-based lending and factoring. So I don't think that our client base, I think if you're a manufacturer in Windsor or Red Deer or Columbus, Ohio, you don't necessarily get the difference between factoring and an ABL line. And a lot of ABLs are sort of pseudo factoring, and a lot of factoring is pseudo ABL, and so it's hard for the market that doesn't live in this day to day to understand what the difference is.
The largest difference really in the connotation between it is just the legality. Are you buying a receivable versus lending against a receivable?
Right.
And it has very different legal structure. So when you buy an asset, it's like buying a car, buying a home. It's something that you own. It can't be primed by priming interests like the federal governments in Canada or the United States, the tax man, Uncle Sam, and so on. And so you don't have priming interest in issues. So when you've got a balance sheet that's maybe a little more troubled, and you're kind of looking at alternative finance, and we always say there are no balance sheet covenants and requirements traditionally, but when you get one that's a little bit more troubled than another, factoring is generally a route that you can take. You can still do factoring with notification or without notification. So the without notification part still has the look and feel of an ABL type facility. The customer doesn't necessarily know.
The without notification.
Without notification,
yes.
That's right. So without notification, the customer doesn't know, so it has a feel of ABL, but the legality or more strength on the underlying legal documents of buying the asset.
Right. So my experience is, if I'm the business owner, and this is about getting 85% or 90% margin on your receivables. Right. That's the goal here. I've got $1 million receivables. I would like 850,000, 900,000 financing.
Right.
Against that receivable. I don't really care if I'm borrowing that on an ABL or selling that on a factoring agreement. It's just a different set of documents. Absolutely. Is that fair to say?
Very much so.
Okay.
The only subtle difference in the mechanics of it is that it would be a borrowing base on an ABL versus a schedule of accounts on a factoring facility. So on a non-notification factoring facility, from a structure standpoint, it might be a little bit more laborious for the client to be gathering copies of invoices and purchase orders and so on, and providing the supporting backup, as opposed to an ABL where you would just have a borrowing base once a week or once a month.
Yeah, but on the borrowing base, you're going to do a roll forward of your AR. There's going to be field audits. It's not easier.
It's absolutely not easier.
Right.
A lot of people have. In our opinion, it's easier on the factoring side. We still provide. Accords, roots are in factoring. We've morphed. The majority of our facilities are ABL now. Yeah. But they're not easier from the client's perspective.
So if I'm borrowing, I don't really care. It's different. Right. And it depends on the situation.
Well, and the good part is that we can provide the flexibility of both. It could be ABL. If you're used to ABL, most clients that we find are transitioning from the bank that are used to that borrowing-based type facility. It makes it simpler for them to go into an ABL type structure.
Yes.
And for those that haven't been borrowing with the bank or kind of dealing with those issues and kind of just going through some transition or growth or whatever, they don't know any different, and factoring is a good solution. Right.
What about notification? I do care about that.
Sure.
So I care about rates.
Yes.
And I care about notification. So
Absolutely.
Notification means to me that when you buy the receivable as a factor, the factorer then sends a note.
Yes.
Right, to
your customer,
to my customer. So we run a company, so they send a note to Home Depot.
Yes.
And they say, hey, we just bought this receivable. We're a factoring company.
Yes.
And my experience is that is actually pretty common in the U.S., but much less so in Canada. And business owners have a fear that there's a stigma attached to that sort of notification. Right. Have I got that right so far?
I think so. So far, so good. It's gaining notoriety in Canada for sure, but it's still years behind the United States. Right.
And so, but here's what I find interesting from a factor's point of view, is that if I'm advising a company, working with a company, and I say to the factorer, I would like to do this factoring arrangement, non-notification, 100% of the time they say sure. Like they want it,
and then 10%
but they're
of the
willing.
time,
But
10% of the time they close on it.
Yeah. Well, that's true too. But they're willing to give up on it. I find so from a lender's point of view, from a factorer's point of view, what's the benefit of the notification versus non-notification?
The biggest part is verification. It really kind of comes back down to the state of the balance sheet and the cash declaration.
Is it a real receivable?
Right. And can you verify that independently of your client?
Right.
That's kind of the number one element of, with factoring that dates back hundreds of years sort of thing. The number one element is that third party confirmation or verification.
Yeah. And there's lots of ways to mitigate that risk.
For sure. Well, especially with technology and so on now.
Exactly.
Online systems and EDI and so on and so on. There's a lot more ways to get information.
What is AR management?
So we'll kind of manage the collection and reporting of your receivables, and we can also provide credit guarantee. So think about it like an insurance with an EDC or a Euler and a Tradius type of insurance program where you're going to have kind of, the first loss is X dollars. You're going to have a copay then of like the 90%
copay,
and so on. So our guarantee program provides just that. It's a guarantee. It's not insurance. So for whatever reason your customer doesn't pay other than actual dispute, like I didn't receive the goods or services, we would make good on that and pay 100% of the value of the receivable.
Really?
So that's where Accord kind of started in '78. Is that receivables management and credit guarantee business?
I never knew that.
Yeah.
So
that's how we can provide factoring, for example, either with recourse or without recourse.
So is that a legitimate option for me as a business owner versus going to EDC or,
it can
as you
be
said,
because
or Tradius?
I mean, and so it's a bit of a different program. Whereas EDC and Tradius and so on, you're still doing all of your own back office. You're doing the receivables management.
Absolutely. You're
following up for collections, and so if you want to build a staff and people and have a back office to manage that, great. And if you don't, then we take on that function.
How do you have the ability to do the credit checks when you do that?
So a lot of it is kind of coming back from our 40-plus year database,
Okay.
And then others is that we're kind of gathering information on public companies. It becomes easy.
Yeah.
With private companies, we go through credit applications, bank references, trade references, and again, I mean, so you're outsourcing that solution. So you can ask your customer for a credit application, and then we'll do all the back office. So we're getting constantly feeds of credit applications that we're doing bank and trade references on behalf of our clients.
Do credit insurance brokers know about this?
Yes. Mm-hmm.
Really?
Yeah, that's kind of our best source, to be honest, of business, is through the credit insurance brokers. Now, most of our business lately has been coming from kind of the one-offs. So they're looking for top-ups and so on of, some of the more difficult credits, or they've got concentrations and they're looking for additional coverage and so on and so on. But that's kind of, where a lot of that business is coming from.
I'm intrigued by that. I didn't know that at all. How about lender finance?
So lending to other lenders, it's in Canada especially, the banks just don't seem to like to lend to other lenders. They either see them as competition or they see it as risk. So we're providing financing to other factoring companies, leasing companies, merchant cash advance companies. We looked at a subprime auto loan business. They actually ended up funding that with their own equity, but it was one that we looked at recently. Just providing finance to other lenders.
With my business owner's hat on, if I were to randomly look at 100 factoring companies in Canada and the US, not the big ones,
right,
but the ones in my local community, what percentage of those have money?
I hate to say it's a low percentage,
like
but
10, right?
Even given my experience, I mean, I've been with some of those entrepreneurial businesses. Yeah. I've managed and owned my own factoring business that I ended up selling twice because the biggest constraint to being a lender is capital.
Right.
So if you hit the lottery,
so it's really low.
It's low. Right.
Right. So
but
really,
equally a percentage of that, how many of those would be Accord clients? That's a higher percentage.
Well, this is where I was heading with that. So a lot of these local community, I don't know how to express it, but these smaller factoring companies.
Entrepreneurial factors, for sure.
They're entrepreneurial. Mm-hmm. They're 4 or 5 or a group of high net worth individuals, or not necessarily running the place, but their database, right? So they get your deal, and they sign it up,
right?
And it's conditional, and then they go to their 1 or 2 or small group of high net worth individuals, and they say, "Here's a deal. Do you want to do it?" It's almost like a brokerage operation from my point of view.
Yep.
Okay. And so the point I'm trying to make is that happens a lot.
Absolutely.
So as a business owner, we talked before we got on air today about counterparty risk. Who is this financial institution?
And it's a significant risk when you think about things like your reserve, right? If I'm only advancing 85 cents or 90 cents on the dollar, and I'm collecting 100 cents on the dollar, and we're building this reserve, if for whatever reason, your kind of counterparty or your lender fails, those reserve monies kind of end up going into a trustee, and who knows what happens with those funds. I mean, it's a reality. It's a reality.
Exactly. And so as a business owner, know who you're dealing with.
Absolutely.
And recognize that a significant chunk, percentage-wise, not the mainstream players, not the bigger guys, but a significant chunk of this industry is really almost an intermediary brokerage type business, not a direct lender.
Right.
Okay.
Well,
and that's a risk to you.
And if you Google search factoring or Google search ABL, and you'll see hundreds of names that come up, it's a very small percentage that are actual direct lenders. You'll find more brokers or intermediaries.
And this is way worse in the U.S.
right,
than it is in Canada, right?
I think so.
At one point in my life, I was convinced there was only about 3 people in the U.S. with money,
right,
and everybody else was just some sort of brokerage front.
It's more now, but I think a number of years ago that would have been true.
Yeah,
yeah,
that's what I think too.
Right.
And so one of the interesting things about Accord is that you're public,
Right.
right? So as you're looking at counterparty risk, you know, I can't think of anybody that's your size in public.
Catalyst.
Calidus? Are they your size? Yeah, I guess they are now.
Larger. Yeah, they're larger.
Yeah. So there's one.
Right.
But you know, it's not common. So you can dig in as a business owner.
Right.
You can dig in and see who you are, what money do you have, you know, are you making money, are you losing money? Because you know, on one hand, you complain about rates and administration and all that sort of stuff. But on the other hand, you want your counterparty to be making money.
Absolutely.
Right.
Absolutely.
Yeah. Okay. Retail inventory financing
is kind of a product that's near and dear to our hearts. We have a lot of experience, and again, kind of dating back to 40 years in the retail trade of working in the credit guarantee business and understanding kind of, you know, how retail works and spins and so on. So we can provide direct finance to retailers. So we're financing their retail inventory that they're selling directly to. So unlike an asset-based lending type of situation where you're selling commercially, you've got receivables, sometimes you need lending against the inventory that's priming for the receivables. In these cases, there are no receivables because they're selling to individuals like you and I.
Yeah.
And so we're helping them to replenish inventory, to buy inventory, and kind of, you know, keep their facilities, you know, up and running, so to speak.
I think of that as being the history of the court.
For sure.
In Montreal in the garment trade. Is that accurate?
1000%. Absolutely.
Okay.
Absolutely.
All right.
Yeah.
Hey, Ash. Maybe we should have some more martinis.
Absolutely.
Equipment financing. So this is just term loans on equipment.
Yes. And that's primarily through our partners at CapEx. So CapEx will provide facilities in Canada and the United States. They're based in Chicago. They've done recently a couple of deals in Canada. One was the Dicom deal. So Dicom's a large courier that does business cross-border, Canada and the United States. Not quite FedEx, but it's Canadian FedEx.
We'll talk about mine
Absolutely. We provided them a $20 million facility to kind of help refresh their fleet. So they're buying new trucks, new trailers, shifting equipment, and so on. So there's a $20 million facility there. And more recently was a food manufacturing company who was manufacturing packaging, clamshells, and so on. We provided them a $9.5 million facility to buy new equipment.
So is this typical? You get the appraisal and you're doing 80% of NOLV or whatever?
It can be, or a lot of it's even kind of just acquisition of new equipment. So in the case of Dicom and this the packaging company was just the acquisition of new equipment. So we're kind of taking a look at, you know, debt service and the ability to service debt and providing financing on that basis.
Okay, now we're getting to the fun part. Supply chain finance.
Supply chain finance.
Which
sexy,
I think...
Very sexy term these days, by the way.
Well, I don't think this product exists except for Kevin.
Right.
I think you're the one that... I've never heard about this before except from you.
Okay. I mean,
walk
it
us
is
through
actually very common.
Okay.
And there's a number of different ways to do it. We do it kind of, you know, maybe what's considered to be an industry less accepted or less known type of scenario. I mean, so the most common scenario is that your lender will essentially buy goods and then resell the goods to you.
Right.
They'll generate a trade receivable that they actually look to credit insure. So they're going to credit insure that underlying receivable. So the caveat being that your counterparty or your client has to be insurable. So ours is a little bit of a different approach. I mean, we're providing unsecured finance to help clients acquire goods. So ours is very complementary with bank finance, for example. And it really became more of a build towards PO financing. So PO financing requires that senior security, that we have to have a GSA or a lien against the business. It was always difficult to try to negotiate that with the bank. With our form of supply chain financing, we're kind of not acting as the buyer or the seller, but as a straight financier. So we're actually funding our client's payables, and our client agrees to pay us, up to 120 days. And so we're providing them kind of that off-balance sheet financing that the banks like, that we like, and obviously kind of meets the client's needs.
So, if I can summarize this, because you've loaned to it or led to it, that we have a business in Ottawa that manufactures tools in China, brings those tools to Canada, and resells them to retailers in Canada and the U.S. Effectively.
Yeah.
Under this program, if I have it right, because we never use this program, but you would actually, Accord would buy the goods.
Accord would pay for the goods, so the client still buys it.
The client still buys it.
So we're not acting as the
So you're
reseller
paying my Chinese manufacturer
on your behalf. And then you
assuming Trump doesn't ruin that by Friday.
right.
But you pay my Chinese manufacturer directly.
Yes.
Right? And then what do? You take a PIMSy on the even?
No.
Nothing?
No. It's your promise to pay.
Okay. And I pay 120 days later.
Yes.
So instead of having, go ahead, Ashley. Martini shaking, always 3X.
Absolutely. Takes priority. Takes priority.
So instead of my usual terms with a Chinese supplier, which could be all over the map, but
COD or
in this case, it's some
30%,
upfront,
70,
some before they release the
right.
The goods at the customs send the release.
Right.
So instead of that, I get 120 days. I basically extended my terms.
Yes. Thank you, Ken.
You're welcome.
Take a bunch of that right now. Not the vodka, the supplier credits.
Right. Right.
But
So the
also
caveat to that then is kind of the client's ability to, or our interpreted ability to repay the debt.
Right.
So we're not looking at, in the case of purchase order financing, you can take the client out of the mix because you're looking at the counterparty. So if you're selling it to the Home Depot, we're less concerned about our client because we're looking at the Home Depot strength.
Right.
So
does it come with a factoring piece on that or a...
No. So traditional spaces for this, and I'll kind of talk about maybe a couple of the clients that we've done recently. One is that they've got a $4.5 million line of credit. Things are going well with the bank. They're doing about $50 million a year in sales, and they had a competitor essentially that went bankrupt. So they were looking for about $1 million roughly to be able to acquire their competitor's inventory, which they knew they were going to be able to flip in 3 or 4 months at a pretty significant profit.
Yeah.
And so they go to their bank and, hey, we got this opportunity, our utilization's up to about 90%. We just don't have the utilization to make the payment. So it didn't fit for them, but the bank called us and said, we've got this opportunity. And that's an excellent kind of example of, you've got a creditworthy client with their $4.5 million line of credit. They just needed this extra bump. They knew that they could make that sale and kind of underlying and kind of it ended up transitioning through there.
What are the rates on that product?
So the rate kind of counts as you get the first 60 days free, and then it's 2% for the next 60 days. So it's 2 to 2.5%.
So it's similar to your AR financing.
Well, AR financing goes more on a monthly basis. So think about
that works out sort of the same, I think, doesn't it?
No. So AR financing would be more than what supply chain financing would be.
How does that make sense?
Just credit risk. Credit risk is different. I mean, your client's balance sheet is much different. I mean, again, in most cases, your client has their bank line of credit, a much stronger balance sheet, and so on, as opposed to the the turnaround situations or the kind of the higher risk type situations.
Okay. What is a cord octet? Isn't that what we just talked about?
Yeah, so Octet
that's
is
the same as supply chain.
Yeah, so that's the platform. That's the actual physical platform that we use. So that's kind of the Fintech solution. Because we do it through Octet. So the way that it works is that our client would register or sign up with Octet, and then their suppliers would also kind of register and sign up with Octet. There's not a contract or an agreement or whatever. All it is that they enter into this platform, and the supplier says, here's my performant invoice. And then the client logs in and says, okay, I approve that invoice for payment. And we match the two and then make the payment on their behalf.
Okay.
So that's
you specifically want to talk about Fintech today. Fintech solutions. It's on your notes to us. Before we get there, which would be sort of the last 2 or 3 points on the product lines of Cord, talk to me quickly about industries. What industries do you guys love? What's hot these days? Do you do any cannabis?
So I mean, manufacturing has kind of always been a staple for us, and it's because we can kind of finance up and down the balance sheet. So because we can provide lending against receivables, inventory, machinery, equipment, with manufacturers and all of that space. And manufacturers have their raw, whip, and finished types of goods. We've always been akin to manufacturing. Food and beverage has been hot as of late as well. I think it's probably easier to talk about some of the industries we don't like.
What don't you like?
So it's kind of the construction space.
Right.
And the technology space. And the technology space, I say it's because of progress or milestone type billing, where you're working on a project with someone and, I'm going to do a 30% down and then progress draws throughout, a 6, 9, or 12-month type contract.
Sure.
So anything with milestone or progress type billing makes it difficult to provide
But
financing.
you do like SaaS, for example. You like maintenance contracts associated with technology.
So contracts that are certain, for example, right?
Or a portfolio of
right?
Yeah, you would do that.
Yes.
In a heartbeat.
Yeah.
Yeah. Okay. Cannabis.
So cannabis has been the hot topic with us. So cannabis, the answer is yes. We have a syndication, as I mentioned, of 6 banks. 4 are Canadian, 2 are U.S. So there's still some
So
discussion.
you can't leverage it?
I think we can leverage it.
Okay.
So hopefully Stuart's on air, and Stuart Adair is our CFO, and I know he's having open discussions with our lenders. But it looks like leverage can be yes, and if it can't be leveraged, then it's equity, and I think we'd be okay with that too.
So a big part. Say that last part again. Oh, yes. If
Right.
it wasn't leverage, you'd be fine with it. So a big
Right.
part of cannabis lending would
The
be
build
a
side.
term requirement,
You got it at the beginning for sure.
which is you have a Chicago partner
Right.
for that.
Mm-hmm.
And
Well, no, I mean,
they
so that,
can't
I
really
think that's
do it,
something we would do directly. So we
You would
take-
have to.
Yes, yes.
right?
Yeah.
And so that's
And
going
we're
to
looking
be
at a couple of those opportunities now.
that's going to be greenhouses, equipment, process
So we're talking
facilities.
to a client right now that's got that they're looking to acquire some extraction equipment.
Exactly.
Right. So the extraction side, they're extracting CBD from hemp and so on. That they're
Right.
working at right now. That they need X equipment or they
Yeah.
need greenhouse equipment and so on.
Make sure they have supply locked up.
Right. Right. And then eventually though that it kind of naturally turns into an ABL type solution as they're converting sales and and they've got receivables and
Well, receivable ABLs,
Right.
not an inventory.
right. Yeah.
Right.
With your inventory going up in smoke.
Or down the drain.
Right. Right.
All right, let's move on to fintech. Define, I don't know what fintech is, other than just a software online solution
It's
to lending or anything to do with financial institutions.
the short form, obviously, of financial technology is really just that. It's a platform of really kind of moving the human element out of credit adjudication and underwriting. So how
Right.
can we kind of move away from the more traditional underwriting type space where you've got so many touches and an underwriting team and so on to, an age of expediency.
Yes.
In an information age, in an age where people are looking for instant results, you're not going to research things and so on. I want an answer. I need an answer now.
Yeah.
And so the answer, has to be a yes or no. It can't be an application with a stack of documents and you'll let me know in a few weeks.
Or months.
As the case may be. As the case may be. And so,
So I was reading through I got notes from your website, which I then read. Servicing alternative lending companies, servicing consumer and commercial markets. So is this similar, or is it merchant advances on the commercial side? Is it payday loans on the consumer side?
So our platform is Accord Access,
Yeah.
and we're providing what we're calling small business loans. We're not kind of associating them as merchant cash advance because it's not tied to a historical POS type of sale.
Right.
So rather than looking through your 12 to 24 months of historical POS that a retailer would have, so your point of sale type
Yeah.
of transactions, debit cards, credit cards, and so on, many of our clients would not have those types of machines because they're construction companies, because they're regular businesses that don't take credit card sales or debit sales. They're not dealing direct to retail. Our loans again are a little bit different. That we prefer structures of about 3 to 6 months with a quick turnaround, and that's because it's more project segmented type financing. What I find with the MCA side, and again we work with a number of MCA lenders, so I'll kind of bite my tongue a little bit. And the guys that we work with are pretty well advanced. A lot of people try to solve problems with more money. They just think that money can solve the issue. I'll go out and grab this advance, and I'll go out and grab this advance. I can get funding in 12, 24, 48 hours, and I'll get this $100,000, $200,000, $300,000 in, and it's going to solve all my problems.
Right.
And then 3 to 6 months later, they're in the same issue, only worse because of the the rates that they're paying on those types of loans. So
We'll get to it in a minute, but we're doing a 10-part series, Olga and I, on how to finance a troubled company.
Right.
And that is specifically
Yes.
one of the points,
Yes.
right? And I never understood why lenders to this space, and we mentioned the Canadian lenders, same in the U.S., why they think that the exact same management team and business plan that got themselves into this position,
Right.
why they think just giving them more money is going to help. Lenders buy in.
Right.
So you just said that the company, the management team thinks that's going to help them, but lenders also think that the extra $200,000 is going to help them, which I just find bizarre.
Yeah, and I think it could be an interesting mindset in a couple of areas. One is that a lot of these businesses these days are actually funds. So it's always interesting to see how well invested the principals of those companies are into their own funds, so to speak.
Yeah.
So it becomes more of a casino model, right? As long as the house is full, the casino's making money.
Right. Interesting.
And so our program specifically, though, is kind of, we won't allow stacking, which is kind of taking on multiple loans. We look at 3 to 6 months, and essentially, if we don't think we can provide the solution,
how do you stop
we
stacking?
Just don't want it then. Do a lead search. I mean, 99% now.
What if they're
FCA,
not registered?
There's very few that don't. I'm not aware of any of them besides us that won't register a PPSA or a UCC. So we'll still do a search.
So if there's a prior advance to the company from a competitor or somebody else,
right?
You just say no.
It's a decline.
It's a decline.
Yes.
You rank ahead of them. You don't care. It's just a hard decline.
There's no subordination. It's just a decline. You don't. You have an underlying issue. If you're coming back for your second, third, or fourth, this is not helping the situation.
Right. And that's the way the industry's going, right? There are second, thirds,
especially in Canada. I mean, especially in Canada, the industry is moving away from stacking.
Away from stacking,
right. So you might get 1 or 2 now, whereas in the U.S. still you can get 2, 3, and 4. And I think we were kind of talking off air that there's now these consolidation companies out there that allow you to consolidate your MCAs into one loan,
one easy payment,
right? One easy payment of $99.95 a day.
You're going to hear the commercials on Fox News,
probably coming soon.
I think I was telling a story in an earlier episode that we had a client in Michigan, and he had one of these things for 500 or some number, and then another merchant advance company was harassing him, and they wanted to give him 600. So he took it. So he was stacking,
right?
And he thought it was going to fix everything, like you said. Whereas it turned out, in retrospect, he went under 30 days later. But a condition of the second advance was that they had to pay $250 to the first guy. It's the craziest thing I'd ever heard of.
Why are you helping him solve his
exactly?
Right. Yeah.
But it was flat out a condition.
Right. Yeah. Here, let's help him get $250,000 closer. That's interesting.
Yeah.
Yeah.
It's not a well thought out industry.
It didn't sound like it for sure.
So let's talk about the good side of that product.
Yes.
So I'm a small business. I'm my guy in Ottawa, the company that we run in Ottawa, and I don't have a point of sale. Let me start another way. 2 years ago, a partner of ours in the U.S. started this sort of business, and as I recall, their formula was send us 6 months of bank statements, and we're going to look at everything you deposited. We're going to take an average, and you're eligible for an average over a month, and you're eligible for 40% of that.
Right.
Right. I think that was as simple as that. So if you deposited $1 million on average a month, you get $400,000.
Right.
And then they did daily or weekly sweeps of the account. And they never told you what the interest rate was. It reminded me of auto leases in the 1990s. You remember you used to go in and go like, what is that, Honda? And they used to say, like, it's $212 a month. Like, cool, what's the interest? There's no interest. It's $212 a month. Right. What's the residual? That doesn't exist. It's $212 a month. Right.
Great. It's a bargain, $212 a month.
It reminded me of that. It's just like, this loan costs you nothing.
Right.
We're just taking out $1,012 every day.
Well, and the new wave really is that you're taking out a $250,000 loan, and then when they make the advance, you're really only getting that $210,000. So you're repaying so you don't really see the interest.
It's buried. It's a discounted loan.
Right. It gets buried, and you're paying in advance.
Okay, but what about the formula that I just gave you? Is it similar to that today?
No, I mean it's
like if I'm running a restaurant here in Toronto, how do I know what I'm eligible for?
Right. With our process, it's not necessarily as cut and dry as some of the others that would provide X percentage. Like if we were talking about receivables and factoring, it's that 85 to 90%. It's not as cut and dry on the fintech side with our access program.
Okay.
It's kind of more based on your individual need. So we kind of almost work it backwards. Obviously, we still have kind of that fintech platform, and all that's doing is taking the bank statements and information and so on and throwing it through some analytics. So rather than somebody looking at all the debits and all the credits, you've got software that'll do all that for you and kind of come up with a formula.
Right.
Now the formula, it can be that 20, 30, 40% on whatever you want to set your matrix to under that platform, but it's really our process is more geared towards the client need as opposed to the actual ratio. So we would go up to $75,000 unsecured, so no PPSA or UCC registration.
Yeah.
It's just kind of the unsecured loan, promise to repay, we'll tap. Could be, generally speaking, it's weekly, could be monthly, depending on the situation. And if you allow us to take a secured position, we'll go as far as second, and hopefully you're behind a bank or someone else, a more traditional lender than another MCA. We would go up to $150,000.
Okay. And the rates on this product have come way down, right?
Yes.
So what are they now?
So it's a more competitive landscape. Some of the MCAs would still be up in that 30 to 45 range. Our product is in kind of the 18 to 22 range.
Right.
So maybe half of what more of the traditional MCAs are.
And the 18 to 22 is, oddly, it's precisely what specialty troubled lenders ABL lenders used to get. 3-4 years ago.
Right.
Like not that long ago.
Right.
I mean, they'd be down to 13 now, 11, 12, 13 in that range, but it wasn't that long ago they were getting 18 and 22 in a higher risk situation.
Right.
So these rates are probably going to come down. Listen, you can't live on 18% money.
I don't think anybody can.
Right?
Yeah.
And nor should you.
Yeah.
But if you need a bridge, right? If you need help today that's non-dilutive, you need access to availability. Whenever you're working on the turnaround of a troubled company, having cash that's non-dilutive is king. But then don't waste it.
Right.
Right? So have a plan, make changes. But that's an okay number. If you have a plan.
We kind of use the terminology of expensive debt but cheap equity. I mean, essentially, we kind of just term it as that you're essentially renting equity for a period of time.
I've said this before on these Periscopes podcasts, but back in the day with our friends up the street here who really invented this product, not the MCA, but the asset-based lending, the troubled companies in Canada, and it was an 18%.
Yep.
It was an 18% product. And I used to say to my companies, my troubled companies that I was advising, I say, look, you can't pay 18%. Nobody has the margin for that. Mm-hmm. But it's not just 18%. It's if you have say a $10 million line, it's a 10% premium over what you're paying now. It's $1 million a year to have access to all the availability you need to save your business. Right? Would you pay $1 million fee to have a chance to rescue your business? 100% of the time, the answer is, well, yeah, I do that.
Right.
But I won't pay 18%.
Right. Yes.
Right. And so, it's important that you think of it that way. But you have to have the plan first. You have to be financing something. You can't just be, I want to get another $100,000 in the door.
Agreed.
Which I'm going to waste.
Right. And I think, again, I think the MCA started out as, and the client started out as, this is going to be, excellent quick financing that I can get to, for an immediate need or solution, that ended up being more of Band-Aid type money. And that's where that kind of stacking phenomenon is coming in.
All right. More on Fintech. We covered that?
And Fintech is kind of on our term loan side. I mean, our team's kind of working hard on the middle market side. So, loans up to 25 million on a Fintech platform that doesn't really exist right now. But when you're talking about term loans, it's kind of, you're looking at debt service.
Right.
You're looking at
financials
and crunching.
So to me, the word Fintech in this context, because Fintech is a whole industry. Right. But Fintechs in this context, when they hear from a lender, what they really mean is there's an online application.
Right.
It's formulated, and you're going to get a really quick answer.
Yes.
That's what you're saying.
Yes, that's exactly. I know. I know the industry right now associates Fintech with MCA, but Fintech is completely separate platform. So if you're looking for a middle market, a $20 million equipment financing loan, there's no reason that can't be adjudicated through a Fintech platform.
Right. So we're going to talk next about a series that Olga, you know Olga, who's a VP at Sinclair Range and a bit of a rock star.
Absolutely.
And helping troubled companies get and manage their financing relationships. She worked one-on-one with you at a prior firm, with a client, and she knows her stuff. She does a good job. And so we have this 10-point, 10 tips to help a business get refinanced. And the idea, a troubled business. And the idea is that financing a troubled business requires change, and it requires story because it requires a story because it's a management problem, and management has to change. The way you're conducting yourself has to change. Otherwise, you're just getting a bunch more money, right? And you're going to waste that money, which we've talked about. It's not going to solve the problem.
Right.
So what I struggle with is how does that reconcile with fintech? Because it seems to me that the online application process and adjudicating takes away the ability of the company to demonstrate to the lender that things are going to change, and it takes away the lender's ability to gain comfort in the management team or the new management team and the changes that they're going to make in a transitionary situation.
Right.
You understand what I'm saying?
Yes, absolutely.
So how does that work from your perspective?
I think fintech is never going to replace a good consultant. I mean, from our perspective, or from many lenders' perspective, all we're really kind of looking to achieve with fintech is getting to an indication sooner. So rather than going through a manual process where you've got an application and supporting documents and so on, let us weed through what we can to information-wise. So rather than reviewing financial statements, rather than reviewing bank statements, rather than reviewing invoices and details and so on, let the software kind of get to that part. And so you'll kind of have then an indication of, okay, we think the business can service debt of X dollars. Now kind of couple that with, does the loan make sense? So there's always going to be a human element to fintech, especially in the middle market. I don't think anybody's going to get away from, some sort of human element to lending. I know the banks will, try and maybe succeed and kind of go through, but then they're always going to have that burn rate of X dollars that, they'll have their pool for. Accord doesn't have an appetite for those types of that type of deal flow. So
sure.
All we're really doing in our eyes is helping the client and helping the consultants get to a solution faster.
How does a business owner find your fintech platform?
Hopefully, I mean they've kind of done their kind of research and as much as you're choosing a lender and a lender's choosing you, I mean you have to choose a lender that's right for your business.
Right.
And a lot of
But what are they typing in the search bar? Are they typing Accord Financial? Google it and
or equipment financing or CapEx. There'd be a number of different tags I guess they would come in with.
Yeah.
So CapEx would be one.
But I want them
capital
to get to
expenditures.
yours. If I want them to get to Accord,
Right.
they're just going to go to the Accord website.
Can be. We're pretty high on asset-based lending. We're pretty high on factoring. So purchase order financing. So one or three or four of those acronyms in a Google search should get you to us.
I Googled fintech today in preparation to have a little conversation about this.
Yes.
And to my surprise, Accord was maybe fifth.
Yeah,
like there was a Wikipedia investor, whatever that.
And the good part is Accord is by design with the letter A in front. Always helpful. And some of that, to be honest, dates back to years ago with Yellow Pages. So when Yellow Pages was, when you were listed in Yellow Pages 40 years ago, that was your search engine.
Okay, I don't think the Google search works that way.
Right.
I'm pretty sure it doesn't.
No, some of it. No, and listen, I mean, we've been doing a good job of kind of, I know that there's the SEO.
That's the point.
And our marketing team and so on have been doing a good job with some of the information that we're putting out that's relevant. And we're actually providing a solution. So we're not an intermediary or somebody else that's kind of trying to steer somebody to a solution. I think we're putting out decent content to be able to get there.
Okay, financing a troubled company.
Mm-hmm.
So this is near and dear to the Sinclair Range heart.
Both of our hearts, for sure.
We do a lot of this.
Absolutely.
And we help companies do that, and you lend to companies that are in that situation. Right. So this should be an interesting perspective that's different from mine, or maybe it's the same as mine. I don't know. So I started a 10-part series with Olga about this, and my view is that a lot of intermediaries, and advisors in this market. Like, let's pick on the accounting firms.
Right.
It's not just the accounting firms, it's the business brokers, but they don't know the difference between how to finance a stable, good cash flowing company from a troubled company.
Right.
It's a whole different issue from a lender's perspective. The lenders want security, or the prospect of security. They want to know that there's cash flow to pay them back, and they want to know that there's integrity in the numbers, integrity in the management team,
right.
integrity in the receivable, right? This was the notification, right? And to prove those three things in a troubled situation is entirely different than proving those things in a stable situation, right? So that's the premise of all this. So the 10 points are, number one, as a management team, you have to admit you're in trouble. Right. So all the time you see companies and management teams that if I just get in the extra $1 million, and like everything's going to be fine.
Right. I can see my way through the situation, or whatever the case is going to be.
Right. So you know, I'm not in trouble. I'm just, things have dragged out, and I got an issue right now. More cash, I'm going to be fine.
Right.
Number two on the list is identify what that trouble is and who specifically is responsible. Because it's always a management team, right? It doesn't mean they're bad people, but this wasn't some global economic macro shifting of whatever. It's your failing as a management team to deal with whatever issue
and a foresight or
right.
You know, absolutely.
Right. So to convince a lender that you're serious, that you recognize that things need to change, you need to say to that person, sort of to that lender, you need to say, you know, this is my mistake, and here's what my mistake was, and here's why it's not going to happen again. Right. Identify that person, make a plan to fix the problem. Right. So that's presented in these are points sort of 3, 4, 5. But you know, you identify the problem, you identify who is responsible, or what. Maybe it's all of you, and what you're going to do about it. Like you're going to change that CFO, or you're going to augment your management team. Understand that people like you exist. Right, because it's not just going to the banks up the street here. Right. There's a whole world out there that is in business to lend to these sorts of lenders. Understand that you're going to pay more. Right. It doesn't do you a lot of good to sit there and fight for 3-4% capital, because you're not going to get it.
Well, and really these days it's not that far a stretch from the bank's special loans.
I agree. Expect to report more was the 9th point.
Yeah.
There's going to be higher scrutiny.
Absolutely.
Right. Yeah. And the last one is to look at other options, which means, you know, maybe financing isn't the answer. Maybe you should sell your business to a strategic competitor or whatever, right? So those are my points. That's sort of the formula on how to, you know, how we bring a company to somebody like you. Right. What is it from your perspective that you look for from a troubled company?
I think you kind of covered the key points for sure. I mean, first and foremost is kind of the underlying collateral. We can kind of look past a lot of the situations with two elements, collateral being one, and really it's kind of that viability recipe. Understanding, you know, where they've come from, what the situation was, you know, what ran into trouble, and just understanding the plan to enact change.
Do you, as a lender, when you see a troubled company, are you looking for change?
Depending on the event. So if we can get comfortable on what events led to the kind of, you know, the situation that they're in. So for example, it may have been that they got, you know, a customer that they were somewhat concentrated in, and that customer just failed to pay them. They went bankrupt, or they had an issue. If you were, you know, heavily concentrated in Target Canada, for example, or some of the other situations where maybe it was just kind of, you know, it's hard to foresee that a Target Canada is just going to pull out and, you know, kind of run into these issues. So it depends kind of on the situation from time to time.
Right.
So there could be another situation that we see frequently is foreign exchange. That, you know, I'm buying in U.S. dollars and selling in Canadian, or I'm manufacturing Canadian and primarily my customers in the U.S. and they just don't enact a plan for hedging or foreign exchange and kind of run into those situations. So it may not be a total management breakdown or whatever.
Okay, but in those two examples, they should have been hedging.
Agreed. And or they should have thought about concentration. And my economic dependence on this customer.
I was going to say, it wasn't so hard to see that Target Canada was going to be a problem. I mean, nobody was in the stores.
Right.
Nobody.
Yeah. Well, and again, I mean, so some of the entrepreneurs that have got their head down manufacturing their widgets to be sold to Target may not kind of head out to the Target stores to see. they get, it's glorified. I'm dealing with this massive corporation, they're too big to fail kind of scenario, and so on, and they're really not. Yeah, really not. I mean, so from a foresight, you want to understand that, listen, concentration can be your best friend or your worst enemy. Yeah. In dealing with those situations, or you just didn't have the financial acumen or foresight to understand, the whole premise behind hedging and so on. So
what's the financial ABL rule of thumb on concentration?
For some lenders, it's different than others. We are not afraid of concentrations. So we have some clients that sell to Costco's and other major retailers and so on that we're not afraid of the concentration. Depends on the underlying contract. It depends on a lot of other situations. Some lenders just don't allow concentrations. We're okay with some.
The concentration that they don't allow would be typically
10%.
10%, right?
Yeah.
And some of them will go 15, 20.
Right, and we might allow up to 80.
Wow.
Right.
But as a business owner, if you have one account, that's 10% of your revenue.
Right.
You ought to at least be thinking about it.
Yes.
Right. You should see that as a really a positive.
Well, and especially if you're on a shorter-term contract, or if you're on an RFP type of relationship that you're constantly renewing those contracts. Are you wrapping up capex? Taking on a 5-year lease when you've only got a 1-year contract. Those types of situations. Yeah.
What else do you want to talk about?
The Raptors.
We've got 55 minutes.
Listen. I mean, I think we've covered a lot, and
we can do it again. We don't have to cover everything in one.
That's perfect too. I think. I won't bore you too much more on fintech and in other areas.
I'm intrigued by that.
Listen.
Not all in a positive way.
Right.
I think it's a good solution in the right situations.
Right.
But just what you see going on in the U.S. in particular is worrisome. And the regulatory in the U.S. is crazy.
Right. I think the fear from the lender's perspective is that kind of if you get left behind, do you become a Kodak? Do you become kind of, we're making film for the digital age, so to speak, right? I think it's a matter of somewhat keeping up with the Joneses, and again, from our perspective, there's always going to be a human element, and our preference is always going to be working, with consultants like Sinclair Range. I mean, when clients find us, but it's but equally you're providing that solution to yourselves and your clients, on an expeditious manner.
All right, let's get the music on here. Accord. What's the website? You know off the top of your head?
www.accordfinancial.com.
Accordfinancial.com. Send all of your deals to Kevin.
K. Westfall at accordfinancial.com.
There you go. SinclairRange.com is the Sinclair Range website. If you're looking for help, feel free to email us. If you have suggestions for the show, feel free to email us or Ashley in particular. And I think that else. Did I miss anything, Ashley?
I think we're